Welcome back here with Money, and we are talking about structured products this week. So Feroz has already told us what these products are like and the fact that they are for HNIs and the threshold is about 25 lakh rupees. Now let me get down to the different types of structured products. And Feroz, you've told me in our earlier conversation that they are a mix of debt and equity, and then a mix in terms of the risk appetite as well, whether they're an aggressive structured product geared more towards equity or a relatively conservative which is geared more towards debt. Do elaborate this for us and how this is all structured.
So structured products, like you rightly mentioned, in terms of the risk they take, the market risk they take, they can be categorized as equity kind or debt kind. So if they are debt kind, they need to be principal protected. They have to make sure that under any circumstance of the market, your principal should be protected. These become instruments which come very handy during uncertain times where you don't know directionally where the market is headed, and that fear factor keeps you away and keeps you waiting on the sideline. So principal protected and non-principal protected. The principal protected would be more debt-like, and the non-principal protected will be more like the equity types. So these are the two basic classifications. On the debt category, which are conservative, there are some structured products which also assure you a minimum return. Like a 5%, 6% minimum, and then a market upside. So those are all debt category, and the ones which actually risk your return and also your capital, which are the non-principal protected ones, are actually the equity category. So these are the two basic categories which people use in trying to create a portfolio alongside mutual funds with structured products.
That's exactly what I was coming to. What would be the need to invest through these products? I mean, if you're just looking at adding a little bit of debt and mixing it with some equity as well, you could do that through direct avenues of either direct equity exposure or mutual fund exposure, and of course there are different debt avenues. So then why would you go for these, or is this an add-on that you would advise?
No, I think it's a very, very important question. Like you said, if it is me too, why would I actually add it to the portfolio? One is non-principal protected market participation doesn't exist. So if you want to actually participate in the market, you have a direct equity which will lose you money if the markets take a U-turn. So will the mutual funds in most likely situations. So all instruments, PMS, mutual fund and direct equity, have a tendency to lose money for you when markets take a U-turn and if markets fall 20% due to any unforeseen circumstances. But a principal protected structure product can protect your capital and help you navigate through these volatile times. That's one purpose. So trying to clearly eliminate yourself from market downsides is one. The second thing is structured products can give you a compressed return. What do I mean by that is, if the market goes up, there are structured products which tell you that if the market goes up 10-12% in 3-year periods, will give you 80% return. For example, one of the products which we have been giving to our clients is that if the market goes up 10% in 3 years, cumulatively, which is a minuscule 3% an annum, you will make a return of 80%.
And this is going to be a product which will obviously have a greater equity exposure. It's a more aggressive structured product.
Absolutely. And on the contrary, if the market goes down 10%, you will lose 10%. So it can't be categorized.
But the downside is not protected here. There's no capped.
In this one, it's not protected, is why they are categorized as non-principal protected, equity-like. So see, what happens is if you're going to get 80% return in about 3.5 years with a 10% growth on Nifty, then you don't have to worry that there is a large probability that the market will at least bounce back to 8,300 levels if you are sitting today. So this becomes a very good parallel thing, complementing the mutual fund. It is not contrary, it is actually complementing. See, for the mutual funds to deliver 80%, markets will have to go up 50-60%, but the structured product in 10% growth will give you 80%. So two purposes: protect your portfolio or compress your returns in the first few percent. These are the two basic reasons.
On that note, let me quickly come back to some of the other issues relating to this. What are the other risks that an investor must keep in mind?
See, of course, there are two primary risks. One is, are you okay with the return which the structured product is promising in different market situations? That's the market risk. Okay, if the market goes up X, how much do I get? So you generally, a structured product shows you a graph to give you a simulation at different levels of market what happens. So you need to be very, very comfortable that if the market goes down 20, are you comfortable losing 20? If you're not, then you have to change your product. So one is market risk. The other primary large risk, and the rest of the subset risks are a different story, is the issuer's credibility to repay you the money. at the end. Just like when you buy a bond, you see his rating, or maybe you see the credentials, the balance sheet and stuff. If the corporate is managing the money properly, there is a large propensity that he will not default. So these are the two risks. One is the credit risk, one is the market risk. The good part is the credit risk is very well mitigated by having a trustee. These are secured debentures. Unlike a bank fixed deposit, there is no trustee. Here there is a trustee who actually, now for example, Anand Rathi's trustee is one of the largest trustees in the country, who acts like a custodian to collateral in the favor of the bondholder. So to summarize, two major risks. I will not go into the sub ones. One is the market risk, the other is the credit risk. Credit risk is an important risk which gets eliminated, but because of its secured nature, and the issuer gives collateral to the trustee.
But are all structured products secure, or again that will depend on which product you're using?
99.99% of the structured products are secured in nature, and especially the ones which Anand Rathi has issued, all of them are. So they could be unsecured, but 99% of them are secured.
Okay. Now, another basic question. My understanding is that these products are more design-driven. They're not so much manager-driven. It's not like a mutual fund where every 10 days or 15 days you see the market and there might be a tweaking of the portfolio or tweaking of the, the fund choices as such. That might be a good thing. I mean, it's less human intervention, but what if the market stops behaving in the manner in which you had forecast, and then therefore are these products therefore less flexible? And during the tenure, what happens if the market performance is not as what you had anticipated?
Absolutely. Actually, you've hit the nail on the head. The difference is, in a mutual fund, there's human intervention. Here, there's no human intervention. If somebody's got 100 rupees, okay, making sure 30 rupees is mechanically managed with no emotions. Anyone's, for example, fund managers or yours, it is just mechanically managed. Here there's manual management. Of course, there are flip sides of mechanical management, but if you're looking at a mediocre market performance of about 8-10% in 3 cumulative years, you'll at least get 1 year which will give you those 8-10% at least. So you reduce your expectation from the market to mitigate this risk of wanting to change your opinion in every few months. So yeah, large portion of your money should be human intervened, and some portion of money, which is 25-30%, should be mechanically managed in the form of a structured product.
Okay, on that note, we're going to take a break, and that should have answered some questions that our viewers might have had on this slightly new investment avenue. We'll take a very quick break, but we're not done yet. Still ahead, we'll be answering some of the queries that have been sent in by our viewers. Stay tuned. More coming up on Money, Money, Money.